Hey everyone, welcome back to Corporate Decoder. Today, we are diving into a company that maybe spent a bit too much on office snacks this past quarter. Let's find out. We will be dissecting Denali Capital Acquisition Corp's latest financial report. This isn't just about numbers, it's about whether this company is sailing smoothly or if there are storms on the horizon, so let's dig in. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Join us and let us know what companies you want us to analyze next. Denali Capital Acquisition Corp is basically a blank check company. This means they were created to find another company to merge with or acquire. As of March of this year, they hadn't started any real operations yet, meaning no sales or revenue. Everything has been focused on finding that target and trying to combine with them. They are just spending money. The report covers their financial activities for the first 3 months of 2025, but let's jump into the financials. That's what's most interesting. Alright, let's dive into the numbers. At the end of March, their cash on hand was just $2,736 compared to almost $17,000 at the end of last year, so they are definitely burning through cash. Most of their assets are tied up in a trust account, which we'll talk about later. Looking at what they owe, accounts payable and accrued expenses are at about $4.8 million. This is up from $4.6 million at the end of last year. It seems like bills are piling up and they are spending more than they did before, which is not a great sign when you don't have revenue. Here's the big one, net loss. For the first 3 months of 2025, they lost $190, $100 and $600 and find a business to buy. In the same period last year, they actually made a profit of $264,330. That's a big swing in the wrong direction. What's causing these losses? Formation and operating costs were almost $247,000. That's the money spent on setting up the company. Legal fees and generally keeping the lights on while they look for a target company to acquire. Last year it was even higher, so they are doing better, but still quite expensive for doing nothing. The small bit of good news is that they are making some money from the trust account, around $79,000. This is basically interest earned on the money they have set aside for the acquisition. However, last year they made a lot more, almost $654,000. The trust account is their savings account and it's earning less than it used to. The company calculates its earnings per share, which is important for investors. The report says the basic and diluted net income per redeemable ordinary share was $0.07. This sounds positive, but remember they had an overall loss, so it's very misleading and useless metric. This section gets into the real flow of cash. During these first 3 months, Denali used $114 forced and $131 in operating activities. This means they are spending more cash than is coming in, which can be a problem if you don't have a lot of cash saved up. To keep the lights on, they borrowed $100,000 from a related party, likely the sponsor. This is a short-term fix, but not a long-term solution. It shows they are relying on debt to cover their expenses. Looking at cash at the end of the period, they only have $2,736 left, down from almost $17,000 at the start. Remember that most of the funds that are in the trust account is restricted and cannot be used. So what's the overall situation? The company is burning through cash, is losing money instead of making it, and it's relying on debt to keep going. Not a great look, but it's important to remember they are not operating. They are looking for a target, but the clock is ticking. Now about this trust account, a lot of their money is stashed away in this account. They say during a shareholder meeting, a lot of shareholders chose to redeem shares for cash. As a result, almost $41 million had to be taken from the trust account to pay them. This significantly reduces what Denali has available for its business combination plans. They had a deal to merge with a company called Longevity Biomedical, but that deal was terminated or cancelled. So they had to start over again. Now they are working on merging with Semner Pharmaceuticals. There have been other issues such as getting kicked off the Nasdaq stock exchange for not meeting certain requirements. This isn't the end of the world as they now are trading on the OTC market, but it makes it harder to attract big investors. Here's where things get real. The report states that there's substantial doubt about the company's ability to continue as a going concern. That means that there is a real risk the company might not be able to stay in business unless they complete their business combination soon. There's also the ongoing world events creating global uncertainty with respect to the war, the sanctions, and so forth. The company admits these events could pose unpredictable risks to the business. Now, looking at these results more broadly, the situation does not look too good. They lost a lot of money, are low on cash, and have a ticking clock. The key is whether they can complete this business combination with Semner Pharmaceuticals. The success of the merger will determine the company's direction. Alright, that's our breakdown of Denali's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. See you next time.